Hi, everyone, and thank you for joining us for the third session of Cherry Bekaert's 2022 Professional Services Virtual Conference Series. My name is Scott Duda. I'm a partner and the leader of Cherry Bekaert's Professional Services Industry Group. Our virtual conference series is designed to provide quality, industry-specific CPE at convenient times, all free of charge. We're offering these general sessions for all professional services firms, as well as sessions specific to A&E firms, law firms, and financial services firms. We hope you're able to join us over the next couple of months as we continue the virtual series. Please visit the link in the chat to register for all remaining sessions. Here's some notes to note before we get started. To receive CPE credit, you must answer at least 3 of the polling questions and attend for full 50 minutes. CPE certificates will be issued via email within 10 days. If you've not received yours after 10 days, please email cbhlearning@cbh.com. A recorded version of this webinar will be available in about 1 week and will be sent via email and posted to our website. If you have questions during the webinar, please type them into the Q&A window located in your control panel. Just another note, a short survey will be posted at the conclusion of the webinar. We value your feedback and ask that you please take part. Now we've covered the housekeeping items, I'd like to introduce today's speaker, Ron Wainwright, partner in our Tax Credits and Incentives Advisory Group at Cherry Bekaert. He's going to be presenting on hot topics and planning opportunities within CHIPS and the Inflation Reduction Act for A&E firms. Ron?
Thank you, Scott. And thank you for joining us on a series of webinars. But today, as Scott outlined, we'll be focused on the hot topics that are contained within the CHIPS Act, as well as the Inflation Reduction Act of 2022, which brings us to our first polling question. How did you hear about the webinar? All right, very good. Let's go ahead and get started with our presentation today. So as I commented, for the next 50 minutes, we'll be going through the CHIPS Act and the Inflation Reduction Act with specific focus to the A&E industry and where the A&E industry is so important to both of these major pieces of tax legislation. So a little bit of background that I think would be helpful around these really 3 pieces of major tax legislation that will impact the A&E industry. If you recall, and we've done some webinars on this, in November of 2021, what was passed was what was referred to as the Infrastructure Investment Jobs Act, signed by the president on November 15th, of $1.3 trillion. So the CHIPS Act, which we'll talk about, was now signed on August 9th of 22, and the Inflation Reduction Act of 2022 was signed on August 16th. The CHIPS Act puts another $257 billion at work in our economy via incentives and credits and deductions and rebates and guaranteed loan programs, as well as the Inflation Reduction Act of 2022 puts another $500 billion. So to frame it from an A&E perspective, literally within the last 16 to 18 months, from a tax legislative perspective, there has been over $2 trillion of tax legislation dealing with credits, deductions, rebates, exemptions, etc. So let's start with the CHIPS Act. The Creating Helpful Incentives to Produce Semiconductors for America, a la CHIPS Act, was signed into law on August 9th of 2022 by President Biden as part of what was referred to and is referred to as the CHIPS and Science Act of 2022. This $52.7 billion package provides generous tax incentives to increase domestic production of semiconductors, also known as chips. While the incentives themselves are narrowly targeted, the expansion of the semiconductor production will significantly benefit the A&E industry from the standpoint of, since the CHIPS Act has been released, which was signed on August 9th, $80 billion of investments have been announced to date by companies that will be building major manufacturing facilities or those underlying suppliers to support the CHIPS Act. From a background perspective, scientific research and development are critical to the economic development, public health, and national defense, with as much as 85% of US productivity growth in the first half of the 20th century really resulting from technological advances. Partnerships and technology handoffs between the federal government, a la the CHIPS Act, and the private sector have contributed to this success. As an example, from a federal funded perspective and the curiosity-driven research, it created the Global Positioning System, GPS as we know it. It created atomic clocks, cancer drugs, web browsers, barcodes, speech recognition technology, AI, and 3D printing. It is expected that the CHIPS Act will see similar results from a historical perspective now looking forward. There's also an increasing global technology of competition, as we know. The majority of chips are in fact produced in Taiwan. And that global technology competition has surfaced in economic and national security concerns, with other nations announcing plans to assume global leadership in key economic and national security technologies, as such as artificial intelligence and microelectronics. Meanwhile, the US federal R&D spending as a percentage of GDP is near to its lowest point in over 60 years. And total US R&D spending as a percentage of GDP has fallen from 4th place in the 1980s, as a point of comparison, to 9th place today, behind advanced economies like South Korea, Japan, and Germany. So to reverse this trend, the CHIPS Act, will authorize in dollar terms the largest 5-year investment in public R&D in the nation's history. And the backbone of all of these manufacturing facilities, these expansion of manufacturing facilities, is obviously the A&E industry, as is the backbone being the A&E industry around the Infrastructure Investment Jobs Act of 2021. Aside from dramatically increasing research funding, the Act will also build new technology hubs across the country, increase participation of underrepresented populations and geographies in innovation, and ultimately combat what is referred to as the foreign absorption or theft of US research projects. Now, probably the major piece within the CHIPS Act is what is referred to as the new Section 48D Advanced Manufacturing Investment Credit. And that is where, since August 9th, there has been $80 billion of announcements from companies, as I am in Raleigh, such as Wolfspeed, who's announced a $5 billion investment in a new advanced manufacturing facility. For background purposes, as an A&E firm, you are likely to receive a lot of questions from your clients in regards to all of the advanced energy credits, as well as the manufacturing investment credits, as you begin to design, as well as architect and engineer these advanced manufacturing facilities. So the credit, for your purposes, is 25% of the qualified investment in an advanced manufacturing facility. So as an example, as Wolfspeed in Raleigh spends $5 billion, they are entitled to $1 billion of 48D or advanced manufacturing investment credit. Again, the primary purpose is the manufacturing of semiconductors or semiconductor manufacturing equipment, but it does not end there. It is all the underlying suppliers attributable to the manufacturing of semiconductors. So there are multiple credits, as I'll highlight in a few slides, around credits to the suppliers around advanced manufacturing facilities in regards to chips. The credit will generally apply to property placed in service after 2022. So you may already be designing facilities, advanced manufacturing facilities, supply chain facilities that ultimately go in service in 2023, 2024, 2025. Most importantly, in regards to this Section 48D, to my Wolfspeed example in Raleigh, a taxpayer can elect to treat the credit as a tax payment, or in essence, it's a refundable credit. So if you're Wolfspeed, the government is subsidizing your build to the tune of $1 billion. So the other thing I want you to take away in regards to the CHIPS Act from an A&E perspective is all of what is referred to as other credits, loans, and grants that were contained in the CHIPS Act. And there are substantial, which I'll also speak to and highlight for you. But now let's move to the Inflation Reduction Act of 2022. It was signed into law on August 16th. This was actually a surprise when there was a brokered deal in the July months between Senator Schumer of the Senate and Senator Manchin of the Senate. Traditionally, when we think about the Build Back Better plan, the Inflation Reduction Act of 2022 is really the remnants of the Build Back Better. Again, signed into law in August of 2022, and most provisions take effect January 1 of 2023. So let me talk to you a little bit about what has happened in the background of the Inflation Reduction Act of 2022. First of all, the provisions in it are permanent through 2032. So it is very important to understand as we walk through all these credits, the deductions, the rebate, the exemptions, the transfer of deductions, that this is permanent in the statute through 2032. And there are a multitude of clean energy tax credits and deductions which are available to taxpayers. And as you all are the A&E firms that design facilities to ultimately manufacture numerous of these clean energy, you will be asked multiple questions as to the design of the facility. I will tell you that the following discussion is limited to certain highlights of the Inflation Reduction Act, given the time we have today. So let's get a little bit deeper. So these are two very important existing credits, because when you think about the Inflation Reduction Act, think about it in the context of Section 45 of the law and Section 48 of the law. Section 45 of the law talks about really a production type credit, and 48 talks about an investment tax credit. Now we're going to go in much deeper detail into Section 179 and the tremendous expansion and the benefit of the energy efficient commercial building deduction specifically to A&E firms in a few slides further. But there is now an existing credit and an expansion through 2032 of what's referred to as the energy efficient home construction credit. It was expanded from $2,000 under old law to now $5,000 per unit. So for you A&E firms who are designing as well as maybe developing and engineering multi-residential projects or mixed-use projects, it is likely that your client will talk about the necessity to meet the energy efficiency standards per unit attributable to this now $5,000 credit, expanded and extended through 2032. Section 179 we will talk about further, but just takeaway is that it is a modified formula to determine eligibility for new construction. So you're going to get a lot of questions around, am I meeting the new STAR standards so that I can move the 179 cap D deduction from $1.80 to $5 a square foot? And for most of you A&E firms on the webinar today, you realize that if it's a governmental entity, they can transfer that deduction to you. So again, Section 48 is what's referred to as an investment credit. So beginning construction, but it was extended to the end of 2024. There is now, above and beyond what I called the CHIPS Act, a energy investment credit that can be generated in regards to the design of a solar and wind facility, specifically in a low-income community, housing projects and tribal lands. And so you'll see an extension or an expansion, and the credit rate, which we'll talk about, can be boosted significantly. Within the Inflation Reduction Act and the existing credits, there was the Section 30D alternative fuel vehicle refueling property credit. That is, again, not a new credit, but an existing credit. As you all are designing various facilities, you may get asked this question around, well, is my facility going to qualify? And now I want to chase the 30% of the basis of the property. And so they're going to look to you as they are designing their alternative fuel property to make sure that it meets the standards. Ultimately, it raises the overall credit limit to $100,000 and again extended through the end of 2032. There's the 40A biodiesel fuel, renewable diesel and alternative fuels credit as well that was extended again through 2024. So when you think about the Inflation Reduction Act and all of the clean energy, one of the things that you may be asked as you're beginning the design work is a new credit called Section 45W, which is referred to as the Qualified Commercial Clean Vehicle. Now, you're going to be asked likely to ensure that as you design work, that you have electric vehicle chargers within a facility. And so when you think about the vehicles, the reason you're being asked that question is that all electric vehicles, hybrid plug-in vehicles, fuel cell vehicles are going to receive a credit equal to 15 or 30% of the basis of that vehicle. Well, that vehicle doesn't go anywhere without an electric vehicle charger. And so there is a immediate movement afoot in regards to ensuring that EVCs are being expanded into commercial properties and multi-use properties with respect to EVCs. So I just want you to be aware of that new Section 45W. Within the Inflation Reduction Act, there is a series of new credits. 45X actually is an advanced manufacturing production credit. Remember 45 and 48. For components and critical minerals sold after 2022 for ultimately the production of solar energy components and wind energy components and inverters and battery type components, or what are called wafers, if you will. Again, you will be being asked to design or expand or renovate existing facilities, but you will further be asked to make sure as well, you know, I'm looking to take advantage of the 45X credit. I'm looking to take advantage of other Section 48 credits. And so you need to be conversant in this, and that's where Cherry Bekaert can assist you. There's also a new Section 45E, which is what's referred to as a credit investment in energy storage technology. So you will likely be asked in the design of a multi-use facility or a commercial building where they are going to put in an energy storage technology or an energy management system. When you look at the roof, that's where the energy storage technology will exist, attributable to potentially alternative energy and solar. There's also new credits for what's called credit for production of clean hydrogen, electricity, and fuel. Again, just need to be conversant in these. So now let's talk about what are referred to as the boosters. So there is a boost, if you will, or a super boost, is that you can ultimately receive 5 times the base amount of a credit to the extent that you meet certain prevailing wage as well as apprenticeship programs. Now, Treasury is expected to release regulations probably later next year. So in the interim, any facility that you are in the process of designing that you expect that could be constructed and then placed in service in, let's say, 2023, or you may have already designed something and your tax or client is now going to look at you and say, well, look, I'm now considering all of these. I know it's going to go in service in 2023 or before 2024, as I said in the other slide. And they're going to want to make sure they capture that 5 times the base amount, or what's called the booster or the super booster. Now, Treasury, again, has not promulgated regulations around prevailing rates or anything attributable to apprenticeship type programs. They also will give us some domestic content requirements. Now, this is going to be specific to activities that occur in low-income communities, and housing projects, and former energy communities near coal fields, rural refineries, such as the discussion that occurred between Senator Manchin and Senator Schumer to ultimately pass the Inflation Reduction Act. And then there's also activities that occur in Native American lands, or also in Alaska Native corporations, to attributable to these boosters. So it's important to understand as you are designing all of these facilities. Now, why do I say that you're going to design all these facilities before I go to this slide? So within the Inflation Reduction Act, there are significant dollars that have been allocated specifically towards loans and grants in the Inflation Reduction Act. This is where your clients will likely make applications for a guaranteed loan, which can be converted into a grant to build their facility. So as an example, there are $837 million in loans and grants that will be allocated by the Department of Energy with respect to energy efficiency, water efficiency, climate resilience, and affordable housing. And so that is likely what you're going to see in your practice as you're beginning to speak to your clients about, hey, I'm utilizing a DOE grant or a guaranteed loan to build this facility. There's another $291 million in grants from the transportation side, the Department of Transportation, for what are referred to as eligible entities to carry out projects that either produce, transport, blend, or store sustainable aviation fuel, or develop or demonstrate low emission aviation technologies. So over the next 10 years, the airports, if you work in that in the A&E area, are going to expand significantly attributable to this competitive grant program. There's another $3 billion, which provides direct loans to taxpayers to re-equip, expand, or establish a manufacturing facility in the US, which would ultimately produce what's referred to as low or zero emission vehicles, going back to my electric vehicle charger and the credit, as well as the vehicle credit there. And then there's another $5 billion to give you just a sense of the breadth and the depth of the Inflation Reduction Act in that $520 billion. There's another $5 billion in loans to help retool, or what's referred to as repurpose or replace infrastructure that has ceased operations. So you may see opportunities in a mill town, textile, where you're now going to rebuild, or in a West Virginia coal facility where you're going to retool or replace that infrastructure that has ceased operations and turn it or pivot it into an energy infrastructure facility. But you're going to need to understand. So just to give you a sense of the loans out there, as well as the grant programs that are there. So one thing I also wanted to mention before we get into this monetization, there is a new provision, and again, remember 45, remember 48, but it's called 48C. So this actually came about in the 2009 American Recovery and Reinvestment Act, which ultimately established a 30% tax credit, i.e. a 480C credit, for which was awarded competitively on the basis of recommendations by the Department of Energy for specific investments in manufacturing or clean energy facilities and technologies and equipment. The Inflation Reduction Act provides or really repurposes the old 480C 2009 credit by providing $10 billion in new funding for this program and actually expands the categories of qualifying energy technologies with the goal of building facilities that are robust from manufacturing capacity to supply the clean energy economy. So among other categories of the qualifying manufacturing and recycling projects are also those that produce electric and fuel cell vehicles, which we talked about in their components, refueling infrastructure, which we talked about in regards to the airports, and ultimately renewable energy and equipment and components where there's a credit as a supplier. So that is where you're going to see a lot of interaction over the next 10 years because all of these credits are in fact permanent. Among the other considerations from a Department of Energy perspective, which will impact you, will ultimately be how the DOE awards these type of credits. And they're ultimately going to be driven by great job creation, reduction in greenhouse gas emissions, short time to completion, et cetera. But the takeaway for you is it's a 30% credit. The credit is at a base of 6%, as I said in the prior slide, but there is ultimately $10 billion that has been allocated over the next 10 years to subsidize all of these manufacturing facilities, as well as the credits from that standpoint. So let's go back to the monetization piece. So I talked to you about the boosters, where you can ultimately get up to 5 times the base. So for, from an A&E perspective, 179 Cap D is not falling in necessarily to this booster, but there are prevailing wage requirements as well as apprenticeship programs. But the monetization of what is called direct pay is applicable specifically to tax exempt organizations, government units, tribal governments, and similar organizations. And they can elect to refund the credit from the government, as I indicated, from a Wolf Speed perspective. Or there's also a transferability provision around how I get to monetize these credits in my facility. If I can't utilize those, I can actually transfer the credits to vendors, in essence, sell them. And this will ultimately impact what is referred to as kind of the equity financing markets. The one thing I do want to mention is hopefully a number of you all from an A&E perspective take advantage, if you are in essence a startup A&E, with respect to the research and development credit. Now, this credit is a dollar for dollar credit. It's been in the statute since 1981, but there was a change in the Inflation Reduction Act. You can now elect to apply that credit as you were in the past against the payroll tax liability, but the tax liability was expanded to include Medicare tax as opposed to just FICA, and the Inflation Reduction Act doubles that eligible amount to $500,000 per taxable year, effective for years beginning on or after January 1 of 2023. And as I said, it was expanded to not only traditionally or old law offset FICA, but now you can offset FICA and Medicare tax attributable to the payroll tax liability of the entity. It can offset it for 5 years. And so this again is the startup provision. I wanted to mention it to you because of the expansion. Individuals, obviously we have a lot of individuals that may be in A&E firms that are in a pass-through environment. So there's also good news, not only at the entity level, but also at the individual level. I mentioned these only to show you the depth and breadth of the Inflation Reduction Act. So you have 25C, which talks about energy efficient improvements to residences, 30% of a credit towards insulation and windows and doors. So some A&E firms may ultimately design, multi-residential or residential. So I wanted to make sure that I mentioned this to you. There's a 25D residential clean energy property, 30%. This is where we get into kind of solar electricity equipment, solar water heating property, geothermal heat pumps. And then there is this new credit, which applies to the battery storage technology, which you're likely to see in you can obviously retrofit historically, but what you're going to see that is you're going to see that coming forward. And again, now the battery storage facility can decrease, as I've highlighted here in my slide. Again, more clean vehicle credits. There's previously owned clean vehicle credits as well at the individual level. Now, that was kind of the good news, not 100% comprehensive, but it gave you an idea of the depth and breadth. But more specifically, you will need to understand and have at least some basic knowledge of all of those various types of credits, because your clients will be asking as you are designing, drafting the facility, the commercial or multi-residential building. I need to make sure that we're eligible for and the facility meets these credits. And this, by the way, is why, because this is what I'm going to be producing from an ITC or a PTC perspective. So the bad news is there were elements of raising revenue within the Inflation Reduction Act. It did extend to 2028, which some of you may be familiar with, which is what's referred to as the excess business loss limitation. So there is a limitation that's now been extended if you happen to be caught in that in the past. There is obviously much buzz around the new corporate AMT, which is really the largest revenue raise within the Inflation Reduction Act towards the corporate AMT, specifically not on a tax basis, but on a financial statement with adjustments, really focused on those top 100 companies, $1 billion of average net income a year. And so, yes, when you think about, the inflation that is occurring and gas prices and, the companies that are posting billions of dollars of income, that was the focus. That's going to be the revenue raise. And then there's also some foreign-owned C Corp provisions in the event you have, some multinational presence. And then there's the excise tax. And then, of course, there's been much written about how there will be $80 billion technically of funding for the IRS, which most importantly is scheduled based on the score of the bill to generate about $180 billion in additional revenue. And so, yes, the examinations of taxpayers, including A&E firms, will go up. So this I put in the statute, in the presentation intentionally, because I would imagine you've already had some discussions, because bonus depreciation ends 12/31 of 2022. So what does that mean? It means that traditionally 168K of the statute told me I could write off any asset that had a class life of less than 20 years, 100%. But starting in 2023, that bonus depreciation reduces to 80, and then another 20% ultimately haircuts down until 2027. So you're going to see a lot of your clients come to you and say, I've got to get this facility placed in service because I want to take advantage of that bonus depreciation provision, likely in 2023, where there's already a 20% haircut and then it phases down. This will incent and drive greater expansion of facilities and you all designing, either it's a commercial or multi-residential. And of course, there's always state tax implications that I mentioned here. I'm going to skip some of these slides because I want to get to some other tax planning considerations or hot topics for you. So you need to really be evaluating prior to 2022 accounting method changes to make sure you're deducting your prepaid expenses, really evaluating your accrual bonuses for S corporation shareholders as well as C corporation shareholders, because there's no accrual allowed. It has to be deducted at an S corp level. C corporations, again, no accrual allowed for the more than 50% of the shareholders. So you really need to pay attention to these accrual for bonuses. Ultimately, the timing of the 2.5 months has always been there and will continue to be there as that's what's called a qualified plan. And then you really need to look at your accounting method changes to either accelerate or defer income, just from a planning consideration. So here we are at polling question number 2. Are you familiar with the 179 Cap B tax deduction? And we can post the poll results. All right, you are somewhat familiar, 57%, not familiar at all, 27%, and then very familiar. So what I would tell you specifically is this is a significant change in the statute. So this is a key planning for A&E firms in regard to your A&E design work, above and beyond all the work that will be coming to you that is going to be driven by the CHIPS Act, as well as the Inflation Reduction Act in clean energy. So let's now talk about what happened in 179 Cap D. So there are major changes and expansions. So the Inflation Reduction Act updates the commercial building deduction, as I previously said, from ultimately the $1.80, which you may recall for those of you who were very familiar and somewhat familiar, you modeled and had to have energy certified 3 areas of a building: the shell, the mechanical, and the lighting, 0 to 60 cents per square foot, ultimately generating gross square footage of $1.80. Now, why did you care about that? Because if you had a governmental entity at the federal, state, or local level, within the statute, they were eligible to transfer you the energy efficiency deduction, as you all, as the architect firm, were the primary designer of the energy efficient system, as it was referred to, and came in underneath EPACT of 2005, or the Energy Policy Act of 2005. So what happens? It increases the maximum available deduction with respect to that gross square footage to $5 a square foot. So as I said previously, think about the impact of what is a 100,000 square foot building now qualifying for $500,000 at $5 a square foot, where previously you received $180,000 transfer, the $1.80 of that 100,000. Now you're at 500,000. So a significant and a major change. But most importantly, there was an expansion of the eligible buildings that A&E firms may now receive the transfer. For those of you who are very familiar, you recognize that, unfortunately, when it came into the statute, tax-exempt entities were not eligible to allocate the 179 Cap D deduction to you as an A&E firm. Well, now it is expanded effective January 1, 2023, that eligible tax-exempt entities may allocate the 179 Cap deduction to the designer. So this includes, of course, churches and charity, hospitals and private schools, public schools, also projects that could be on tribal lands. So again, 179D is a significant game changer, or what we call energy changer, within the Inflation Reduction Act. Now, there also is new expansion, because traditionally, if you were eligible to have the transfer to you, it was a one and done. So you receive the 179 Cap D deduction and you were done. But now, every 3 to 4 years, a new 179 Cap D deduction may pass to you again, depending upon the relevant upgrades to that building, which were made during that time period. So there's an opportunity under 179 Cap D now, every 3 to 4 years, to evaluate a structure to generate another transfer of deduction to you. So in my specific example, if you 100,000 square foot facility and you receive 500,000 in year one because of the $5 a square foot, then in turn you can monitor in the next 3 and 4 years, depending upon the relevant upgrades, you can receive another transfer of that deduction. Now, we talked about the boosters or super boosters. So to qualify for the $5 a square foot, the construction project must have paid prevailing wages. Now, that's not on you. That's on ultimately the developer. And so that's a question you're going to want to ask or understand, specifically as you design a building where you know that's a federal, state, local, or now a tax-exempt entity that can transfer, or if that facility is on American or Native American land, or you may have done a facility within an Alaska Native corporation. So you want to make sure you ask your client to ensure the construction progress is going to be or meet the prevailing wage, and again, the apprenticeship program that is at least offered. Now, this is where I said we're not expecting this until latter part of 2023. In the interim, you qualify for the $5 square foot. Once the regulations by Treasury come out, they'll probably come out and propose. They'll seek comment. Actually, they've already sought comment in a number of energy provision areas, 7 to be exact. And then you will be in the compliance period. So significant opportunity for those who are very familiar, somewhat familiar, and then those who are not familiar. We are here to help you in 179 Cap D, specifically in the A&E space. And then if you are designing a building for a developer, they're going to be asking you a lot of questions, because in the 179 Cap D area, the old law was you had to certify based on ASHRA. The new law is you certify based on STAR. So it's a lower standard. 45L, you may be familiar with this, is you do multi-residential and design work. This is a credit for the developer. Just wanted you to be aware that changes took effect January 1 of 23. And guess what? $5 per unit. So $5,000 credit per unit, where old law was $2,000. The base is $2,500 now, moving up to $5,000 if you meet what are referred to as the zero energy standards that are, again, forthcoming, but are predominantly STAR oriented. So when you think about that design of the facility, there'll be a lot of questions about, certainly insulation and lighting and topography and where's the building, but also there's going to be a requirement there in regards to the STAR provisions or the energy STAR provisions in regards to the type of, a stove or an oven or a refrigerator that's put in there. But one key here around 45L, if you're familiar with this provision, is that it's now a removal of the height limitation. So multifamily developments may now be at any height where traditionally it was 3 or 4 stories or below. So something to be aware of. Again, I mentioned the energy efficiency standards under changes in 179D and 45L. So again, this is where it's referred to as a zero energy ready home certification. You'll probably get asked questions whether it's a multi-residential facility or a residential. Am I going to meet this new energy efficiency standard, which is zero energy? And really all that means is you are designing a asset that ultimately, if alternative energy such as solar were to be utilized, that home could be 100% energy efficient. It could function on its own. And there's also, in this case, a partial credit available for meeting Energy Star national and regional requirements. So it's really not a federal statute as much as it now we're going to look to the national and regional requirements underneath the STAR to make sure you can receive a partial credit. Again, new prevailing wage and apprenticeship program requirements to get to the $5,000. So that's what you see intertwined from a policy perspective. But you need to be familiar with that 45L, and the standards are there, so we can help you and assist you if you're looking and you're designing something now, because post August 16th, I'm assuming, or you should have been receiving a lot of questions around these credits. But in fairness, your clients may or may not be aware of them, but obviously your opportunity to explain them. And then most of you are familiar from an A&E perspective around a cost segregation, which ultimately takes a real property and identifies personal property to take advantage of that bonus depreciation. Again, you're going to see in our assessment a rush towards putting assets placed in service because of the phase down. But remember that any building over 3 stories can qualify for 179 Cap D, $5 a square foot, and the 45L credit again was expanded to $5,000 per unit. And so when you think about cost segregation and assisting your clients, they're going to be kind of wanting to make sure they understand what that asset looks like from that standpoint. Now, solar credit expansion. This is huge in regards to the Inflation Reduction Act. What I mean by that is that there is an extension through 2024 of the existing what's referred to as ITC. Remember, we have ITC investment tax credit, and we're not even talking today about all the production tax credits. But it's extended through 2024 in regards to solar and qualified fuel, et cetera. Under prior law, ITC was scheduled to phase down between 20 and 23. Now it's permanent, at least through the 2024 cycle. So you're going to see a lot of likely clients coming to you and say, well, I want to take advantage of this solar credit at least through 2024 in my building. What do I need to do to talk to you about that? Again, Cherry Bekaert is here to help you. Remember that it was, if it was placed in service for 2022, it may qualify for the 26% credit. So 26 basically bounced back to 30%. And now we're at polling question number 3. Has your company scoped to see if you are eligible for the employee retention credit?
Ron, while we're waiting for the polling question to end, we did have a couple of questions come through in the chat. The first is there any portion of the CHIPS Act that has a retroactive impact?
No, everything from a CHIPS Act perspective is prospective.
Okay, and then is there still a 20 residential unit requirement for 45L?
Well, there's technically no unit requirement. I mean, someone may have commented to you that, you know, it didn't make sense if you had 5 units. I mean, I know we've done projects for taxpayers that are smaller than 20, so no.
Okay.
I would tell you that 45L, specifically at 5,000, is alive and well. But no, to answer the question.
Okay, great. And then last question we have from our Q&A was regarding the additional costs and just evaluating those to make sure that the costs to meet those energy improvements don't exceed the anticipated tax savings. And I would think that that would be a part of this as well.
Well, correct. But I think what I can safely say, based upon either the CHIPS Act or the Inflation Reduction Act, and I do want to caveat on the CHIPS Act, there are some provisions in the CHIPS Act which talked about where you're already designing the facility and then when it's going to ultimately placed in service. So there is some retroactive nature, but it really depends on when you were either constructing or building the facility and when you started it. So I did want to clarify that. Okay. In regards to, I guess, our polling question number 3, yes, we've already applied 23%. No, we have not. And this is the reason that we ultimately asked this question. I'm glad that some of you at 35% have looked at it. But what we're finding in our A&E firms specifically is that the supply chain disruption has, so remember that when you think about a ability to claim the employee reduction, it was based on a reduction in gross receipts. And it was based on if there was a federal, local, or federal, state, or local municipality mandate that caused a disruption in your business. So we have seen situations in the supply chain prospectively, as well as those federal, state, or local mandates that in fact qualify you for the employee retention credit. And we'd be more than happy to walk you through that. We have a white paper out there on supply chain. So for an example, simple example, let's assume you are an A&E firm, you attend national conferences. Obviously during COVID, you could not have your architects or engineers or your salespeople attend those conferences. You ultimately will be impacted attributable to that because it will be a loss of revenue, not immediately, but a loss of revenue in the future. And that disruption can qualify. You may also have been in a situation where because of supply chain, you had to put projects on hold because the underlying raw materials were not there. So I wanted to put this in here because we continue to see A&E firms miss this opportunity, not our clients, but other A&E firms. specifically in the supply chain disruption and the federal mandate area. Now, I provided you a lot of information here, but I want to be respectful of our time because we're about 10 minutes. So the partial suspension of a more than nominal portion of the business came out in a notice, 2120. And so a more than nominal portion of your operations were in fact suspended because you couldn't attend a conference or there was some type of mandate. So when you think about that, according to the guidance, any suspended portion of a business operations is to be deemed more than nominal if 10% or more of the business operations were impacted. So very important when you think about the mandates to evaluate this IRS notice, which we have found that unfortunately, if you're not working with us, many have missed. Again, there's some opportunities and traps around the government mandate. Again, delays and partial shutdowns due to government orders which affected the supply chain likely can impact you as well. And so we want to make sure we at least highlight that for you as a hot topic. We talked about R&D credit and not leaving money on the table to make sure that you've taken, whether you're a startup and or we want to make sure you're not leaving money on the table. Also, the SALT cap. Some of you may be familiar with this election if you're a pass-through entity, but we don't want you to overlook it. Basically, there, as you know, in the Tax Cuts Jobs Act, you as a pass-through were limited at the individual level to $10,000, but there's been major changes of what's called the pass-through entity election, which changed the landscape under Notice 2020-75. There are more and more states that are enacting this, but ultimately you claim the tax deduction at the entity level, therefore working around that $10,000 limitation that was in the Tax Cuts Jobs Act. So currently there's legislation pending in Iowa, Pennsylvania, and Vermont on top of those that have already adopted the PTE. And here is a that I wanted to put in here as of October of 22 that says first year applicability, states with PTE elections, so that you don't overlook the pass-through entity election, claiming that tax deduction, removing that $10,000 threshold if you were not to make the PTE election. Last is what we are seeing in regards to A&E firms is there is some contraction. Obviously, the work is, I'll say, people constrained. So there's not as much capacity given everything that's coming towards A&E firms, specific to the design of facilities, $80 billion just in the CHIPS Act of new facility announcements. Well, there is an A&E firm behind that. And when you're announcing a major facility like Wolfspeed did at $5 billion, the estimate is that there will be suppliers that will likely invest in facilities that will likely equal the $5 billion. So you look at that announcement and say, really, $80 billion turns into $160 billion of whether it's the primary manufacturer or all those suppliers. And of course, all of them need facilities. And that's where you come in. So we do see a lot of play in regards to succession planning in A&E firms, irregardless of size, type of entity matters, ESOP, increased gift tax exemptions, et cetera. I wanted to highlight this just because we recognize there is some contraction given the resource constraints in the A&E community, which brings us to our final polling question. Remember, you needed to answer 3 of the 4. Would you like to learn more about how your firm can take advantage of the CHIPS Act and the Inflation Reduction Act of 2022? I recognize we put a lot of information in front of you. We did not put all the 1,000 pages of the Inflation Reduction Act and or the CHIPS Act there. And of course, there's also further opportunities. We've done webinars to take advantage of in regards to the Infrastructure Investment Act of 2021. So I want to thank each of you who attended today. I hope it was informational, it was educational, and more importantly, there are very specific takeaways for you to consider and learn more about and ask a lot of questions to your clients. Obviously, from a Cherry Bekaert perspective, we have outlined a lot to you. This information has been presented as general informational purposes, and the facts and circumstances that you have as an A&E firm or your client may have as a client of your firm is going to be very facts and circumstances when we talk about the credits, the rebates, the deductions, the exemptions that are in the CHIPS Act and the Inflation Reduction Act. Again, my name is Ron Wainwright. I'm a tax partner. I'm the leader of our energy and cost segregation practice. We have a team of approximately 45 people in what we refer to as TCIA. We stand ready to help and assist you along with Scott, our industry leader. And I just want to say, we've got about 3 minutes left. I just wanted to say thank you for joining us. And I hope it was informative and educational and you've got some takeaways. So I'll turn it back to Scott.
Great. Thanks, Ron. I don't see any additional questions in the Q&A. I do see that Maddie has just sent the link to everyone to register for future sessions. And so that concludes our third session of the series. I want to thank you all again for joining us. Thanks to Ron for his insights and valuable tips. If you have any additional questions, please reach out to us at any time. You see Ron's contact information here on the screen. A reminder, we value your feedback and ask that you take part in the short survey as you leave the session. And then last reminder, please continue to check our registration site for remaining sessions, as well as the recordings of those sessions that we've already had. The next one is on Tuesday, November 29 at noon Eastern, and will be on the law firm of the future. Thanks, everyone.